Everyone says it quietly at first, then louder, then confidently, almost casually. This time is different. A phrase that feels intelligent, measured, even reassuring. But history doesn't hear it that way. History hears a warning. Because every major financial collapse, every bubble, every moment people thought they had finally figured it out, started with that exact belief. So what makes this time feel different? And more importantly, what if that's exactly the problem? Let's start somewhere uncomfortable. Not with numbers, not with charts, but with behavior. In 2006, people weren't panicking about housing. They were celebrating it. Home prices had been rising for years. Banks were approving loans faster than ever. Ordinary families suddenly felt like investors. Owning one home wasn't enough anymore. People wanted 2, 3, sometimes more. And why wouldn't they? Every year, prices went up. Every year, it seemed smarter to buy. Every year, the system rewarded belief. Until it didn't. The crash that followed in 2008 wasn't sudden. It only felt sudden. Because people weren't watching the right things. They weren't watching debt levels quietly rising behind the scenes. They weren't watching lending standards slowly weaken. They weren't asking, what happens if this stops going up? Because in their minds, it wouldn't. That's the first pattern. Not the data, not the economy, but the mindset. The belief that growth has become permanent. Now fast forward. Today, the language is different. The tools are more advanced. The economy is more complex. But listen closely. The belief sounds familiar. You'll hear things like, inventory is low, so prices can't fall. Demand is too strong. Real estate always goes up long term. And again, on the surface, those statements aren't wrong. But they're incomplete. Because markets don't crash when everything is obviously broken. They crash when things look stable, but aren't. Let's pause here for a second. Ask yourself, when do people take the biggest risks? Is it when they're afraid? Or when they feel safe? The answer matters more than any statistic. Because risk doesn't disappear when people feel confident. It hides. And over time, it builds. Before the last crash, banks created complex financial products that most people didn't fully understand. Mortgage-backed securities, collateralized debt obligations, layers of risk packaged as safety. But the danger wasn't just in the products. It was in the assumption behind them. The idea that housing prices would continue rising. Always. So even risky loans seemed acceptable. Because rising prices would cover the mistakes. That assumption became the foundation of the system. And when the foundation cracked, everything else followed. Now here, where things get interesting. Today's system is not the same. Regulations are tighter. Banks are more cautious. And on paper, the structure looks stronger. So why are people still uneasy? Because the surface has changed. But the behavior underneath hasn't. Instead of reckless lending, we now have something quieter. Something less obvious. A shift in affordability. Home prices have risen sharply in recent years. But income hasn't kept pace. At the same time, interest rates increased. That combination creates pressure. Not immediate collapse, but slow tension. Like a structure being pulled in two directions. People are still buying homes, but they're stretching more to do it, taking on higher monthly payments, accepting tighter financial margins. And just like before, it feels manageable, because as long as nothing goes wrong, it is. But that's the part people tend to ignore. What happens if something does go wrong? A job loss, an economic slowdown, a sudden increase in expenses. In a strong system, shocks are absorbed. In a fragile system, they spread. And here's the critical detail. Fragility doesn't always come from obvious risk. Sometimes it comes from overconfidence. Let's go deeper. In previous cycles, housing demand was driven heavily by individuals and families. People buying homes to live in. Today, there's another player. A powerful one. Institutional investors. Large firms buying single-family homes. Not to live in them, but to rent them. On one hand, this adds demand, which supports prices, but it also changes the dynamics. Because these investors don't think like homeowners. They think in terms of returns, efficiency, scalability, and if conditions change, they can exit faster than individuals. That creates a different kind of risk. Not emotional, but strategic. Now imagine this. A market where prices are high, affordability is stretched, and a portion of demand comes from entities that can move quickly. Does that feel stable or sensitive? This is where the phrase returns. This time is different. And technically, it is. The causes aren't identical to 2008. The structure isn't identical. The players aren't identical. But the pattern, the underlying human behavior, the confidence, the assumptions, those feel familiar. And that's what history pays attention to. Not surface differences, but repeating cycles. Because every generation believes it has more information, better tools, smarter systems, and in many ways, that's true. But information doesn't eliminate risk. It just changes where the risk hides. Sometimes it hides in complexity, sometimes in confidence, sometimes in the belief that we've finally outgrown the past. But we haven't. No market is immune to correction. No system is too advanced to fail. The question is never if risk exists. It's whether people are willing to see it, or whether they've convinced themselves that this time is different, and that nothing can go wrong. But what if that belief is exactly what makes things fragile? Because when enough people stop questioning risk, risk stops being visible. And when risk becomes invisible, it becomes dangerous. This isn't about predicting a crash. Not yet. It's about understanding a pattern. One that has repeated across decades, across markets, across generations. A pattern where confidence grows quietly until it becomes certainty. And certainty is where problems begin. In the next part, we'll go deeper, not into headlines, but into the mechanics, the pressures building beneath the surface, the signals most people overlook, and the subtle shifts that often appear right before things change. Because if this time really is different, then we need to understand exactly how, and exactly why that difference might not protect us. It might expose us. There's a moment in every cycle when everything still looks fine. Prices are holding, Transactions are happening. Headlines feel neutral, sometimes even optimistic. And yet, something underneath has already started to shift. Not loudly, not dramatically, but quietly, almost invisibly. Because markets don't break at the surface first. They break underneath. Let's look there. Start with something simple. Affordability. For years, housing prices have climbed faster than incomes. Not slightly, but meaningfully. At the same time, borrowing costs have changed. Interest rates, once extremely low, moved higher. Individually, these changes don't seem catastrophic. But together, they reshape the entire equation. A home that felt manageable a few years ago now carries a much heavier monthly cost. And here where it gets subtle. Demand doesn't disappear immediately. People adjust. They stretch. They compromise. Maybe they buy a smaller home. Maybe they move farther away. Maybe they accept a tighter budget. From the outside, the market still looks active, but the quality of that activity has changed. It's no longer driven by comfort. It's driven by necessity. That difference matters, because strong markets are built on flexibility. Fragile markets are built on pressure. Now ask yourself, which one are we closer to? There's another layer here. One that doesn't get as much attention. Liquidity. In simple terms, liquidity is how easily something can be bought or sold without affecting its price. In a healthy market, liquidity feels invisible. You list a home. You get offers. You sell. But when liquidity tightens, things slow down. Homes sit longer. Buyers hesitate. Sellers adjust expectations. Not dramatically at first, just slightly. But that slight change is often the first real signal. Because once transactions slow, price becomes more sensitive. And sensitivity changes behavior. Sellers who once felt confident start watching the market more closely. Buyers who once felt urgency start taking their time. That shift doesn't crash a market, but it changes its direction. Now let's connect this to something deeper. Debt. Not the kind people talk about casually, but the kind that quietly shapes decisions. Every home purchase today is tied to a financial commitment, often a large one. And when borrowing costs are higher, that commitment becomes heavier. People aren't just buying a home. They're locking in a long-term obligation. Again, that's not unusual. But here's the difference. When people take on obligations during periods of high confidence, they assume stability, stable income, stable expenses, stable conditions. But stability isn't guaranteed. And when assumptions meet reality, pressure reveals itself. This is where small disruptions matter. A company slows hiring. A sector faces layoffs. A local economy weakens. None of these events trigger immediate collapse, but they reduce flexibility. And in a system already stretched, less flexibility means more fragility. Now layer in something else. Psychology. Because markets are not just numbers. They're decisions made by people, repeated at scale. When prices rise, people feel rewarded. When they feel rewarded, they feel confident. When they feel confident, they take on more risk. It's a loop, and it works until it doesn't. What breaks the loop isn't always a major event. Sometimes it's just a shift in expectations. A moment where buyers stop assuming prices will rise quickly. A moment where sellers stop expecting strong demand. That moment is rarely announced. It just happens. And once it does, the entire tone of the market changes. Let's pause again. Think about this question. What keeps a market moving forward? Is it fundamentals alone? Or is it belief? The answer is both. But belief often moves faster. And when belief slows down, fundamentals have to carry more weight. If they can't, the system adjusts. Now here where the phrase returns again. This time is different. And again, it sounds reasonable. Because today's challenges don't look exactly like the past. We don't see the same kind of reckless lending. We don't see the same financial instruments dominating headlines. But we do see something else. A market adjusting to a new reality. Higher costs, tighter conditions, more cautious participants. And adjustment is not the same as stability. Adjustment is what happens before stability is tested, or before it breaks. Now consider another angle. Time. Real estate doesn't react instantly. Unlike stocks, which can move in seconds, housing moves slowly. Transactions take time. Decisions take time. Reactions take time. That delay creates an illusion. It makes the market feel more stable than it actually is. Because changes are happening, just not all at once. So by the time a trend becomes obvious, it's often already been in motion. This is why early signals matter. Not because they predict the future with certainty, but because they reveal direction. And direction is everything. Right now, the signals are not screaming. They're whispering. Affordability tightening. Liquidity slowing. Psychology shifting. Individually, each signal seems manageable. But together, they tell a story, not of immediate collapse, but of increasing pressure. And pressure over time. Forces change. The real question is whether the system can handle pressure. It's how much pressure it can handle before something gives. Because every system has a limit. And that limit is rarely visible until it's reached. In the next part, we'll explore something even more important. Not just the pressure inside the market, but the forces outside it. Policy decisions, economic shifts, and the larger environment shaping everything beneath the surface. Because sometimes, the biggest risks don't come from within the system. They come from the world around it. And when those forces collide, the idea that this time is different faces its hardest test. Up to this point, everything we've explored lives inside the housing market. Affordability, liquidity, behavior. But markets don't exist in isolation. They sit inside a much larger system. A system shaped by forces no individual buyer, no single investor, and no single institution can fully control. And this is where things become more complex. Because even if the housing market were perfectly balanced, which it never is, external pressure can still change everything. Let's start with the most influential force of all. Interest rates. Not just as numbers, but as decisions. When central banks adjust interest rates, they're not trying to control housing directly. They're trying to manage the broader economy. inflation, growth, stability. Housing just happens to be one of the most sensitive areas affected by those decisions, because housing depends heavily on borrowing. When rates are low, borrowing feels easy. Monthly payments are manageable. Demand increases. When rates rise, everything shifts. The same home becomes more expensive to finance. The same buyer qualifies for less. The same decision carries more weight. And this isn't theoretical. Over the past few years, rate changes have already reshaped behavior. Buyers who once moved quickly now pause. Sellers who once expected multiple offers now wait. And yet, prices don't always fall immediately. Why? Because of something called stickiness. Sellers remember what their homes were worth at the peak. They hesitate to lower expectations. Buyers remember lower rates. They hesitate to accept higher costs. So both sides wait. This creates a standoff. And during that standoff, activity slows. Not a crash, but a freeze. Now here where it gets more interesting. Interest rates don't move randomly. They respond to inflation. And inflation has been one of the defining forces of recent years. When prices across the economy rise, central banks step in to slow things down. Higher rates are one of their main tools. But those tools come with consequences. Slower borrowing, reduced spending, cooling demand, not just in housing, but everywhere. And when the broader economy slows, housing feels it. Because housing depends on confidence. Confidence in income. Confidence in stability. Confidence in the future. Take that confidence away, even slightly, and decisions start to change. People delay moving, delay upgrading, delay investing. Again, not dramatic, but directional. Now layer in another force. Employment. A strong job market supports housing. People feel secure. They take on long-term commitments. But if employment weakens, even modestly, that confidence shifts. Fewer new buyers enter the market. Some existing homeowners feel pressure. And pressure changes behavior faster than data reflects it. Because data looks backward, behavior moves forward. Let's step back for a moment. We now have multiple forces interacting. Higher borrowing costs, persistent inflation, slowing economic momentum, shifting confidence. Each one on its own is manageable, but together they create something else. Uncertainty. And uncertainty is one of the most powerful forces in any market. Because when people are uncertain, they don't always act logically. They become cautious. Or in some cases, they overreact. Now consider this. What happens when uncertainty meets a market already under pressure? Not necessarily a collapse, but increased sensitivity. Small events start to matter more. Small changes feel larger. And this is where the system becomes unpredictable. Because it's no longer just about fundamentals. It's about reactions. Now let's introduce another layer. Government policy. Policies can support markets. They can stabilize them, but they can also distort them. For example, incentives designed to make housing more accessible can increase demand. But if supply doesn't keep up, prices rise. Similarly, policies that restrict supply, like zoning limitations or slow construction, can tighten availability, again supporting higher prices. At first glance, this looks like strength, but over time, it can reduce flexibility. And flexibility is what systems rely on during stress. A system with limited flexibility has fewer ways to adjust. So when pressure builds, adjustments become sharper. Now here's the key idea. All of these forces, rates, inflation, employment policy, are interconnected. They don't move independently. A change in one affects the others, and that creates complexity, not just for analysts, but for everyone participating in the market. Because decisions become harder. Should you buy now? Or wait? Should you sell? Or hold? Should you invest? Or stay cautious? There are no clear answers. And that's exactly the point. Because uncertainty doesn't announce itself loudly. It shows up as hesitation, a delayed decision, a second thought, a missed opportunity. Multiply that across millions of people, and you start to see its impact. Now return to the phrase. This time is different. Yes, it is. Because the combination of forces is different. The environment is different. The global context is different. But different doesn't mean safer. In some cases, it means harder to predict. And what's hard to predict is often harder to manage. There's one more layer to consider. Time again. External forces don't hit all at once. They build. They interact. They compound. And by the time their full effect is visible, the system has already been changing for a while. This is why turning points are so difficult to identify in real time. They don't look like turning points. They look like normal conditions, with subtle shifts, until suddenly, those shifts are impossible to ignore. And by then, the narrative changes. Confidence becomes caution. Caution becomes concern. Concern becomes action. And action moves markets. In the final part, we'll bring everything together. Not just the signals, not just the forces, but the pattern that connects them. And the deeper reason why this time is different has always been one of the most dangerous assumptions in financial history. Because the real risk is what's obvious. It's what feels safe, right before it changes. At some point, every cycle reaches a moment of clarity. Not when everything breaks, but just before. A moment where all the signals, all the pressure, all the external forces quietly align. And yet, most people still don't see it. Because nothing looks obviously wrong. That's the final pattern. Crashes don't begin with chaos. They begin with normality. Open house signs still go up. Listings still appear online. People still talk about long-term value. Life continues. And that's exactly why the shift is missed. Because human beings don't react to slow change very well. We are wired to notice sudden danger, not gradual pressure. So when risk builds quietly, it rarely triggers alarm. Instead, it blends in. And over time, it becomes the new normal. Let's bring everything together. We've seen how affordability has tightened, how liquidity has slowed, how behavior has shifted. We've looked at external forces, interest rates, inflation, employment, policy, each one applying pressure in its own way. But none of them, on their own, guarantee a collapse. That's important, because markets don't follow simple rules. They move through interaction, layers of cause and effect, decisions stacking on top of decisions. And eventually, those layers create a tipping point. Not a specific date, not a predictable moment, but a condition where the system is no longer as stable as it appears. And when that condition is reached, small triggers can have large effects. A slight increase in unemployment, a modest decline in demand, a shift in investor behavior. Things that once felt manageable start to matter because the system doesn't have the same flexibility it once did. Now think about how narratives change. At the peak of confidence, the story is simple. Prices will keep rising. During the shift, the story becomes uncertain. Maybe things will slow down. And after the turn, the story flips completely. Why didn't we see this coming? But the signals were always there. They just didn't feel urgent. And that's the core issue. Risk rarely feels dangerous when it's building. It feels reasonable, logical, even justified. That's why the phrase returns again. One last time. This time is different. And in a narrow sense, it's true. The structure is different. The participants are different. The global environment is different. But the underlying pattern, the way confidence builds, the way pressure accumulates, the way turning points are missed, that hasn't changed. Not in decades. Not across markets. Not across generations. Because at its core, this isn't just about housing. It's about human behavior. Our tendency to trust what has been working. Our reluctance to question stability. Our desire to believe that we've learned enough to avoid past mistakes. And sometimes, we have learned. But learning doesn't eliminate cycles. It just reshapes them. So instead of asking, will there be a crash? A better question is, how resilient is the system right now? How much pressure can it absorb? How flexible are the participants? How quickly can it adapt? Because resilience, not prediction, is what determines outcomes. There's one final idea to leave you with. Power in markets doesn't come from certainty. It comes from awareness. The ability to see both sides. To recognize strength without ignoring vulnerability. And to understand that stability is never permanent. It's always temporary. Always evolving. Always dependent on conditions that can change. Sometimes slowly. Sometimes suddenly. So when you hear the phrase, "This time is different," don't dismiss it. But don't accept it blindly either. Look deeper. Ask what's actually different. Ask what hasn't changed. Because the answer is rarely found on the surface. It's found in the pattern beneath it. And that pattern has a long history. A history of repeating itself. Just differently enough that each generation believes it's seeing something new. In the end, the housing market isn't untouchable. No market is. What is powerful, almost untouchable, is the cycle itself. The cycle of belief, of expansion, of pressure, of adjustment. It doesn't disappear. It doesn't retire. It doesn't learn in the way we expect it to. It simply continues, shaped by new conditions, driven by familiar behavior, and understood only by those willing to question it. That's the real difference